Welcome everyone to yet another amazing revision session on CA Final Financial Reporting. And in this particular video, we are going to revise a lovey-dovey cutie Ind AS 102, that is share-based payment, a very scoring Ind AS. Also, just before starting, let me tell you, this is going to be a 100% English revision lecture for my lovely South India students. Okay, so here we are going to revise all the concepts along with the important questions also we will revise, right? Okay, so let's start the revision. Acha, if you are watching this on YouTube, before watching, if you haven't subscribed the channel, watching the revision without subscribing, so first subscribe and then only watch. Also, if you have any friends, you can share it with them. Also, if you haven't enrolled for the lecture, I have an English batch exclusively for you guys on bbvirtuals.com. If you feel the need, you can enroll. Okay, now let's start the revision in 3, 2, 1 and go. First of all, Ind AS 102 name is share-based payment. Now, what is the meaning of share-based payment? See, it is nothing but an agreement. Agreement between whom? There is one company and another party. Okay, where the company receives goods and service and in exchange it gives shares to the other party. Okay, so now while explaining also, in case you remember, I told you there is an agreement between the company and another party. Okay, that another party can be employee also or can be a third party also. Okay, so share based payment can be between company and employee, or it can be between company and a third party, right? Okay, now the share based payment can be of two types. One is equity settled, so here company will receive goods and service and company will give shares, or it can be cash settled, where the company will receive goods and service but it will give cash. So if it will give cash, how can it be share based payment? Because the payment of cash will be based on the price of shares. How much cash to be given is to be based on the price of shares. So do remember, first, it can be between company and another party. That another party can be employee as well as any other party. And here company receives goods and service and in exchange it will give either shares, equity settled, or it will give cash, that is cash settled. Okay, so done. This was the first point, definition. Then the next point is scope. What is the meaning of scope? Few issue of shares are not covered here. For example, if you are issuing shares to your shareholders like bonus or right shares, not covered here. If you are issuing shares in purchase consideration, not covered here. Yes, but if you are giving shares to the employee of selling company for being in employment, then it will be share based payment. Apart from that, if you are entering into a contract of exchange, right, where you are exchanging a non-financial item with your shares, so in that case, if in that exchange, let's say for example I'm going to buy an iPhone from you, okay, and in return I will give you my company shares. If my intention is to settle on the net basis, that means I will not take the iPhone, I will not give the shares, we will just settle in the incremental fair value, difference between the fair value. If the intention is to settle on net basis, it is not covered here, it will be covered under 109. But if the intention is to settle on gross basis, then it will be covered under Ind AS 102. Okay, done. This was the second point. Next point, share based payment with other than employees. Now let's imagine you are entering into a share based payment with any other party apart from employee. So now it can be of two types. One can be equity settled. So let's just look at the entries. So if it is with other than employees, here it can be equity settled or cash settled. In equity settled, company will receive goods and service and give shares. In cash settled, company will receive goods and service and give cash. Okay, what will be the entry? If you are receiving goods or service, you will either debit the asset or the expense to SBP reserve. Why SBP reserve? Because you are going to give shares. Then whenever you issue the shares, you will say SBP reserve to capital to premium. Acha, if you have promised to give cash based on the price of shares, in that case you will debit asset or expense but credit SBP liability. Why liability? Because you are going to give cash. Whenever you give cash, you will debit the liability and then say to cash and bank. Okay, few examples also I discussed. Acha, whenever you pass this entry, at what amount will I record this entry? So do remember, whenever you are doing the measurement as per 102, in this case, you will record both the debits and credits at first preference, fair value of asset or service acquired. That means, let's say for example, I am acquiring an iPhone from you and in return I am giving you shares. The first preference will be given to the fair value of iPhone. If that is not available, then you will give second preference to fair value of shares given up. Okay, do remember that. This is contrary to what we discussed in Ind AS 3840. Yeah? Do remember that. Anyways, Acha, these board notes I will upload on Telegram. You can download from my Telegram channel description. In description, I'll put the Telegram link. Anyways, okay, done, sir. Now the next point is SBP with employees. Now here comes the important part. where there is a share-based payment between the company and the employee. So first I'm discussing equity settled. So what happens in equity settled? First I will discuss few terms. One is grant date. Grant date means the agreement date, the date when they enter into the agreement of share-based payment. Then it is the vesting period. What is the vesting period? Employees will not get the shares for free. They will have to fulfill some conditions. So during the tenure, they will fulfill the condition, that is vesting period. Let's say I tell the employee to stay in service for 3 years. 3 years is the vesting period. Then there are conditions. Condition can be of two types broadly: vesting, non-vesting. Non-vesting means there is a lock-in period. After you receive the shares, you cannot sell it for 2 years. Lock-in period. Non-vesting condition has no impact on vesting period. Okay. Then there are vesting conditions. Service condition, performance condition. Service condition means the employee has to stay in service for a certain number of years. Okay. So if the service condition is 3 years, vesting period is 3 years. Why do we need the vesting period, sir? Because whatever is the share-based payment expense, you will book across the tenure. You will book across the period. Do remember that. Okay. Then performance condition. Performance condition can be further bifurcated into two parts. One is non-market based condition, second is market based condition. What is the meaning of non-market based condition? Giving such target which is within the control of the employee. Achieving a sales target, profit target, cost target. It is within the control of the employee. So if you have given a sales target for 2 years, or profit target to achieve it in 2 years, or cost target to be achieved in 2 years, then vesting period will be 2 years. Okay. So this non-market based condition are considered while calculating vesting period. But what about market based condition? What is the meaning of market based condition? Imagine I told my employees that you have to achieve a share price target. That means I will give the shares, I will give you some compensation to the employee, either shares or cash, only if the company's share price increases in future. So if the share price goes from 150 to 250, then only I will give the shares to the employee. Now this target meeting is not within the control of the employee. So how to account for this? This we will separately discuss in another point, that is point number 5. Anyways, now in case of equity settled, how will you compute the expense? So it is very simple. Number of employees that are expected to fulfill the condition, multiply by number of shares you offered per employee, multiply by the fair value on grant date. In case of equity settled, we take the fair value on grant date, multiply by expired period, divide by total vesting period minus expense already booked in previous years. Okay. To understand this, I took one example also. Through this example, just remember, if there is a vesting period, on grant date, you will pass no entry. No entry is passed on grant date. Okay. Then if you want to pass the entry on first year end, when you take number of employees, don't take the whole employees. You will also consider the employees that are left and the employees who are expected to leave. You will deduct both of them. Okay. So in first year, 20 left, 30 expected to leave. I will consider both of them. So I will calculate expense only for 950. Achha, similarly, when you come to second year, in second year, you will take what actually left in year 1. Don't take the expectation of year 1 in year 2. You will take only the actual of year 1. You will take the actual left of year 2 and you will take the again expected of year 2. Okay. Similarly do in year 3 also. So to this we came to know how to find the expenditure. Okay, simple. Acha, so do remember, if the vesting period is 3 years, you will not book a single amount of expense on first day, because the expenditure will be booked on first year end. So first year end, second year end, third year end, you will book the expenditure. How will you book the expenditure? So you will pass a simple entry: employee benefit expense account debit to SBP reserve account. Okay, and whenever you issue the shares, you will say SBP reserve to equity share capital to security premium. Acha, by chance during exercise, if few employees do not exercise the option, transfer the balance to retained earnings. Okay, anyways, chalo. So also I told you one thing: in case of equity settled, if any reversal is happening during vesting period, reversal will happen through P&L. But if the reversal is happening post vesting period, the balance of SBP reserve will be transferred to retained earnings. Okay, logic we already discussed. Chalo. On that note, we have one illustration number 7 which we will revise. So what we will do, along with the relevant concept, we will take up the relevant questions also. Okay, and at the end we will see if anything is left, we will take that up separately. So first is illustration number 7 which we have to discuss. I will just revise. Okay. Acha, one more thing, just because I'm discussing the important question, that doesn't mean only this will come in exam. In exam, anything can come, but the main thing is I'm giving you those questions which covers 100% of the concepts. Okay, do remember that part. Okay, so illustration number 7. What is there? 100 shares, 500 employees are given. Okay, now what is happening is, if you read the question on face of it, you will feel the vesting period is 3 years. But ideally here, vesting period was never 3 years. It is said that the shares will vest at the end of first year if you meet the target in first year. So if the target is met in first year, your vesting period is only 1 year. If the target is met in 2 years, vesting period is 2 years. If target is met in 3 years, vesting period is 3 years. Okay. But in this question, vesting period from day one will never be 3 years. Now how to solve this? First of all, to solve this, we prepared a simple table. Okay, in this table, in the particular column, just write each and every element of the formula: employees, shares, grant date, fair value, expired period, total vesting period, and then you will get the expense. So number of employees you already told, we take the expectation also. Then number of shares is given, fair value and grant date we take. Now expired period is till year one end. 1 year is expired. What about total vesting period? Now, if you read the question carefully, in this paragraph, the expectation of first year is given. As on first year, we know two things: that in first year, target is not met, and our expectation is that it will be met in year 2. This is our expectation in first year, that it will be met in year 2. So the vesting period as per first year will be 2 years. Of course, when you come to second year, target was not met. So the vesting period again become 3 years. Okay. So please solve this question. It is a very good question. Only the important part here is vesting period. Then you will calculate the expense. Whatever expense you get, just book it, and on exercise you will just transfer it to equity share capital. Sometimes the face value of the share will be missing, so you can just pass the entry like this. This is how ICI passes the entry. Okay. So this was a share based payment. If you can see, it was equity settled share based payment in case of employees. Okay. So this was one good question which I feel you should definitely solve. Now we will move on towards the next concept, and that is market based condition. Now what is the meaning of market based condition? Remember I told you here in market based condition, the condition meeting is not within the control of the employee. So how to solve this? See, I took one example. So let's say company announced a plan. Okay, condition is that market price should exceed 400 rupees. Now we never know that when this target will be achieved. So in this case, company will estimate a vesting period. On day one, they will estimate. They don't know now when will this target be met. So let's say company estimates a vesting period of 4 years. No matter what, book the expense as per 4 years only. So there are 3 cases I took. First case, condition was met in 4 years. So book the expense over 4 years. Second case, condition was met in 6 years. In market based condition, we are not concerned whether the condition is fulfilled or not. Even if the condition was met in 6 years, you will not defer any expense to 6 years. You will book the expense in 4 years only. So book in year 1, 2, 3, 4. In year 5 and 6, you will book nothing. Only in year 6, you will issue the shares. Okay. Acha, what if condition is met early? Then what to do? Then in year 1 and year 2, you will book the expense as per 4 years only. But if the condition is met early, in year 3, you will book the remaining full expense. So book the expense of year 3 as well as year 4 in year 3 only. Do remember the mistake you will make is, if the condition is met early, in year 1 and year 2, we don't know that it can meet early. So in year 1, year 2, book the expense based on 4 years only. In year 3, book the remaining full expenditure and then issue the shares. Okay. Acha, what if the condition is never met? This extra case I discussed, not covered in your syllabus, but still, whatever it is never met. So whatever is the balance of SBP reserve, we will transfer to retained earnings. Simple. Based on that, we have illustration number 17. You can just refer. It is a very simple question based on the example I discussed. Okay. Then the next point, I guess, is modification. Now, what is the meaning of modification? Modification means, I'll try to explain this with the help of an example. Okay. So in modification, let's say you announce a plan. Okay, 100 employees, 3 years, number of options you are giving is 5,000, fair value is 150. Very good. At the end of year 1, what happens is, acha, what is the meaning of fair value and grant date? So normally what happens is, in ESOP, there used to be some exercise price. In IPCC, you might have remembered that if the market price is 250, exercise price is 100. So employee has to pay 100 rupees, but he will get a share worth 250 rupees. So the expense for company is only 150. Okay. Now imagine what if the market price falls drastically. So the interest in this ESOP decreases for the employee now. So what the company does later on is, company waives off the excise price to some extent. So company will say, acha, instead of giving 100 rupees, now giving 30 rupees. 70 rupees company has waived off. This is known as modification or repricing, where the company has increased the worth for you. How? By reducing the excise price. Now how to account for this? A simple technique you have to use. Treat the original plan separately. What was my original plan? 100 employees, 3 years, 5,000 shares and fair value 150. Treat this part separately. And treat the modified part separately. What is the meaning of modified part? You are waiving off 70 rupees now for the employees. Treat this part separately. Treat this like a separate plan. So how will you treat this? So this was my original plan first. I booked the expense over 3 years. Then modification happened not on first day. It happened on year 1 end. So this date becomes the grant date for modification. Okay, so treat it like a separate plan. Treat it like a plan you have announced for your employees, where you are giving the benefit of 70 rupees. Okay, so on year 1 end you announce the modification. So this becomes the grant date for modification. So vesting period for modification will not be the whole 3 years. It will be from year 1 end to year 3 end. So it will be 2 years only. Okay. And what will be the fair value of modification? The amount which you have waived off for the employees, that is rupees 70. Extra you waived off later on, that is 70 rupees. This 70 will not be directly given. So how will you find it? You will take the fair value after modification on modification date less the fair value before modification on modification date. Let's say you are doing the modification year 1 end, two fair values will be given. That before modification this was the fair value, after modification the company increased the worth and increased the fair value to this much. So that difference you have to take. So do you remember, in case of equity settled, we are not concerned with fair value changes. But why are we considering it here? The simple reason is, in case of modification you are waiving off extra amount for the employees. That is why we are considering it here. So for this modification 2 years will become the vesting period. I told you how to calculate the fair value. Now when will you book the expense for modification? Will I book the expense on year 1 end for modification? No. This is the grant date for modification. We never book any expense on grant date. So for modification, the first expenditure that we will book is on second year end. And then you will book on third year end. So I told you also, the expense will be nil for modification on grant date. Okay. So when you see, if you see closely, we will do one question also for this to just understand this better. Illustration number 10 we have. Now what was there in illustration number 10? Let's see. Illustration number 10. So what is there? So there are 150 shares, 1000 employees, service condition 3 years. Okay. Normal plan is as per 129 rupees. That is the original plan. Account for it separately. Now at the end of first year we repriced. How did you reprice? Because the fair value fell to 50. You repriced and increased the worth to 80. That means how much you must have waived off for the employees? You have provided the benefit of 30 rupees to the employees. Because at year 1 end, fair value fell to 50. See, normally fair value decrease is not my concern. But because of this fair value decrease, I am repricing the options and increasing the worth to 80. How will I reprice? I told you, you will waive off the exercise price maybe. So your fair value on modification is 30 rupees. So you will account for this 30 separately and this 129 separately. Okay. How will I do this? Just see. So prepare two tables for this. Okay. One will be for original plan where you will take 129 rupees and calculate the expense for the 3 years. Okay. Then can I say you modified on year 1 end? You modified on year 1 end. So on year 1 end becomes a date for modification. So during the year 1 for modification, you will book nothing. Okay. So prepare the same table for modified part also, but in year 1 no data will come. Okay. Number of employees copy from original SBP. Only this fair value on modification, it will be the waived amount or the difference amount, that is rupees 30. Clear? And you will book the expense over across 2 years. Why? Because you modified on year 1 end. Because you modified on year 1 end, right? So that is why that year 1 end becomes the modification date. Grant date for modification. On that date you will book nothing. You will book across the periods. That is the concept of modification. Done. We also have one more question based on this, and that is, I guess, illustration number in 20s, I guess it is. Based on modification. Okay. Here. Illustration number 22. Same thing. I have given the solution also. Just remember one point here. Employees are given for 2 years, but here more irrelevant data is given. See, you have been given grant date of fair value. That is important for us. Then they have also given that fair value increased to 1.30. In equity settled, we are not concerned with the fair value increase. Only one line is there. Here you modified in September. 30th September you modified. Before modification value was 0.90. After modification you repriced to 1.05. So you increase the worth by how much? You increase the worth by 0.15 rupees. This is the modification value. And because you modified on 30th September, how much is the vesting period for modification? You modified in totality, there were 3 years vesting period. You modified after 1.5 years. So remaining vesting period in modification is only 1.5 years. See, this was a tenure. You modified somewhere here. After 1.5 years you modified. So remaining vesting period for modification only 18 months. That is 1.5 years. So in the first year end for modification, nothing will come. In the second year end for modification, book 6 months expense. Do remember that. Third year you can calculate, but data is not asked. In question they have only asked till 31st March 13. Do remember that. So we solved this also. Okay. So this was the modification concept which we just discussed. Next concept is cancellation. What happens here? So company announces a plan and then cancels it. So now how to account for this? See, the accounting is very simple. I'll show it to you here. Okay. See, so company announced a plan. Okay. SBP plan. And then for 5 years, let's say. Now everything went good for 2 years. You book the expense for 2 years. In the third year, company cancels it. So our normal logic says reverse it, reverse the expense if cancel is there. No. In year of cancellation, you will have to do three things. First, cancellation is treated like just like a vesting period has ended. Treated like the vesting period of 5 years has now become 3 years only because you cancelled in third year. So just treat it like a vesting period end. So do not reverse the expense directly. First, book the remaining expenditure of year 3, year 4, year 5. Book that remaining full expense in the third year. First thing you have to do. Second, now you will reverse. So you whatever you booked in 1, 2 and 3 years, now you will reverse, and reversal will be transferred to retained earnings. Second thing. Third thing, sometimes in compensation company also pays, sometimes in cancellation company pays some compensation. So make the payment for that compensation. Let's say company is making the payment for 450. So make that payment, pay that compensation as per 450. But when you pay, you will pay from retained earnings. Why not from SBP reserve, sir? Because all SBP reserve have already been reversed. Okay. So you will pay off from retained earnings. But debiting retained earnings, there is a maximum limit given. Whenever you are paying the compensation, whatever is the fair value on the date of cancellation, that is the maximum amount you can debit. So even if you are making a compensation payment of 450, but the maximum fair value on cancellation date is 410, so you can debit only 410 in retained earnings. But if you are making a payment of 450, difference will be transferred to profit and loss. Do remember that part. Okay, so this was the concept of cancellation. We have one question also based on this, that is illustration number 11. What is there? You can see directly the solution also. We had 8 employees in the first year, we booked the expenditure. In second year of cancellation is there. Okay, but in second year there are 9 employees now. So now what to do? Do not do the reversal directly. First book the remaining expenditure. So in year of cancel, just remember 3 things we have to do. Book the remaining expense, booked, sir. Then reverse the remaining expense, reverse to retained earnings, done, sir. Then pay off the compensation. You are making a compensation payment on 95, but the fair value is only 90. So debit only 90, maximum amount will go to profit and loss. That's it. This was the concept of cancellation and modification. Okay. So if you have a look at the chart, what all we have done definition, scope, SBP with other than employees, SBP with employees, market based done, modification done, cancellation done. Right? Simple? Yes, sir. Now we will also do SBP with employees. Okay, we will do SBP with employees, but cash settled. Okay, so now what is the meaning of cash settled? Here company will not give shares, company will give cash, but cash will be based on the price of shares, of course. Right? Okay, so okay, cash settled. Here it is. Now how to do this? How to account for this? So it is very simple. The accounting is same like equity settled. Acha, these are also known as SARs, stock appreciation rights. Also the accounting is same as equity settled, except that whenever you calculate expense, in case of equity, we used to take fair value on grant date. In case of cash, we will take the fair value on each year end. Why the fair value on each year end? The simple logic is because we are giving cash. If the fair value changes, that will affect me. In case of shares, even if the fair value changes, I have to give the same number of shares now. That is why I should take fair value on grant date. In case of cash, if the fair value increases, it will affect me. That is why I will take fair value on each year end. Do remember that. Okay. Then another thing is in entry, instead of SBP reserve, pass the entry SBP liability. Also in equity, do you remember I told you if reversal happens during vesting period, reversal is done through profit and loss. If reversal happens post vesting period, reversal happens through retained earnings. But in case of cash settled, if there is any reversal happening, it may be during vesting period, it may be post vesting period. It will always be done to employee benefit expense, profit and loss. There is no concept of retained earnings in cash settled. Why? Because whenever a liability is reversed, it is always transferred to profit and loss. Do remember that. To understand this part better, we have one illustration number 21, which is a good question. What is there? A normal question where 75 employees, 400 options, fair value is 200, but fair value on grant date is of no use for me. Right? Because there is a vesting period of 4 years. So I will take the fair value on each year end because cash settled is there. So I accounted for this. I prepared the table. I booked the expense across 4 years. Okay. There is a second part to this question as well, where the vesting period has reduced to 3 years. But this reduction we came to know only in the second year. In the second year, we came to know that vesting period is only 3 years. So how will you do for this now? So in the first year, you did not know about this. So in the first year, you will book the expense as per 4 years only. When you come in the second year, your total vesting period becomes 3 years because you modified the vesting period now. In the third year also, it is 3 years now. Because the vesting period is 3 years, in fourth year, no expenditure will come. So simple question, but yes, a good question which you can solve, of course. So this was cash settled for employees, also known as SARs. Now there is one more concept. SARs that vest immediately. What is the meaning of vest immediately? Vest immediately simply means vesting period is 0. There is no vesting period. Maybe employee must have done some good deeds in the past, because of which company is ready to give the shares today. Immediately. Immediately employee becomes eligible. So now when you become eligible immediately, company has to book the expense on grant date only. See, normally we never book the expense on grant date. So this is the only case where, because the shares are vested immediately, full expense will be booked on grant date. And if these are SAR means cash settled. In cash settled, we never consider the fair value on grant date. We take the fair value on year end. But because they are vesting immediately, yet you will take the fair value on grant date only. Okay, do remember that part. So I have written also. In above case, in case of that vest immediately, vesting period is 0. Full employee benefit expense will be booked on grant date at fair value on grant date. Okay. Acha. In such type of questions, there is one question where even if the employee is eligible on first day, employee is not taking the cash on first day. There is a exercise period of 3 years. So employee can exercise anytime during the 3 years. But there is one question where they have assumed that employee will exercise only at the end of 3rd year, and the employees living in between don't want the cash. Strange, but yes, it is there. So how to account for this? Simple. Book the full expense on first day. So that is illustration number 2. I will show it to you. Wait. There is a illustration number 2, I guess. Here it is, illustration number 2. So what is happening here is vest immediately. Okay. 1st April 95 is the fair value. So because you are booking the fair value on first day, take the 95 as fair value and book the full expense. Now, exercise period is given up to 3 years. So employee can exercise anytime up to 3 years. So normally, even if the employee is leaving during the exercise period, he will take his cash and leave now. But in this question, there are 2 assumptions. First, employee will take the money only at the end of 3rd year. Second assumption is there that employee who are living in between don't want their money. Okay. So what to do during the exercise period? During exercise period, keep on remeasuring based on the changes in fair value. If you see, the fair value is changing during exercise period. So just remeasure. How to remeasure, sir? Simple. Whatever options you are giving into the percentage of expected employee who will stay for the 3 years into the fair value on year end minus whatever expense you have booked. So just keep remeasuring. This is remeasurement based on the changes in fair value. So you will remeasure for year 1, year 2, year 3, and whenever they take the payment, just make the payment at the end of last year. So there are assumptions in this question. Do remember that. Okay, there is one more question, illustration number 24. A very good question. Okay. Here that issue has been resolved. We were discussing now, if the employee leaves early, he will take his money. Here that issue has been resolved, but there is a new concept of intrinsic value here. I will try to explain it to you. It is very simple. See what is there here. So basically there is a question where there are 40 employees on 1st Jan 15. Here vesting period is 2 years and exercise period is also 2 years. That is simple. Okay. So basically employee has to stay in service for 2 years and then they can exercise the shares anytime between those 2 years, between the 2 years afterwards. Okay. Now expectation is that 10% employees will leave and in reality also 10% only left. Okay. Now fair value has been given for all the 4 years. Very good. So what we will do initially? So initially I will say vesting period is 2 years. So book the expense across 2 years. So I booked it across 2 years. That is simple. Now exercise period is also 2 years. 36 employees are there till the end. They are eligible. What is happening is 6 employees will take the money in the first year. Remaining 30 want the money in the second year. And if you read the question, there is also some intrinsic value which is given. Now how to account for this? So simple. I told you one thing only. If in the first year of exercise, there are 36 employees, the employees who want the cash, they will get the cash as per intrinsic value. Okay. But before giving cash, we will remeasure it. So how to remeasure? The employees who want the cash today will be remeasured at intrinsic value. The employees who don't want the cash today will be remeasured at fair value. So first remeasure it. How will I do it? So I will say 6 employees want the cash today, remeasure based on 10 rupees. And 30 employees don't want cash today, remeasure as per 13 rupees. Okay. Less the expense which I already booked. You will get some amount. This is remeasuring. Remeasuring based on changes in fair value. We remeasure it first. And then make the payment to 6 employees. How to make the payment? Based on intrinsic value only. Okay. So in the year of exercise, first remeasure and then make the payment to 6 employees. Okay. Similarly, in the last year, all 30s want their money. So first remeasure based on intrinsic value and then make the payment. Okay. Here the matter of coincidence is intrinsic and fair value are the same. Doesn't matter. they want their money, first remeasure at intrinsic, pay at intrinsic. While remeasuring, do remember, when you calculate the amount, you will also deduct all the expense booked previously. So deduct 2,16,000, deduct 72, deduct 162, but add back one amount. Which amount? The amount of liability which you reversed while making the payment. Add that back. So you will get a reversal during remeasurement. So reverse 30,000 and then make the payment of 30 employees at intrinsic value. Okay, so I have written the concept here as well, that the employees who want their money, they will be remeasured at intrinsic and paid at intrinsic. The employees who don't want their money, they will be remeasured at a fair value. Do remember, my motive here is to revise, so you will understand all these things once you have studied it. Achha, don't expect that, sir, I am studying for the first time, why am I not understanding? Baba, this is a revision video where I'm trying to revise you through things so that you can recall it much in a quicker way. Okay, done, sir. So this was cash settled that vest immediately, or the case, or second question was not vest immediately or 2-year vesting period, but there was intrinsic value also given. Then the next point is SBP with cash alternative. SBP with cash alternative. What is the meaning of this? Here you give the choice to the employees. That employee can either choose cash, or employee can either choose shares. That is the choice of the company. Now how will you account for this? So the accounting is very simple. See, I took a illustration number 3 as the base. Okay, do remember. So how will you account for this? On grant date, do 3 calculations. First, total fair value as per equity settled. So there was one employee who was supposed to get 1500 shares if he choose the equity option, and the fair value was 102. Do remember, in this question there was a lock-in involved. So lock-in is only on shares if you choose equity settled. So take the lock-in price, because if there is lock-in, the fair value will be little less. The lock-in price is given, that if you consider lock-in, the fair value is only 102. Consider that value. You will get the value as per equity settled. Okay. Then step 2, calculate the total value as per cash settled. If the employee choose cash, he will get 1000 shares based on 113 rupees. Okay. Then third step is calculating incremental equity. Total equity minus the cash value is incremental equity. Now how to account for this? Simple. Cash settled, you will do full accounting. Why? Because if the employee chooses cash, company cannot avoid the payment. It is a liability. Present obligation, book it fully. For equity, you cannot book it fully. Why? Then it will come to dual accounting now. Double time expense will get booked. So what to do? So for equity, we will only account for the incremental part. So incremental part, because in equity, employees are not changing. Fair value changes don't affect me in equity. So I will book this 40,000 across the vesting period. Simple. So what do we learn from this? When the option is with the employee, for cash, we do the full accounting. For equity, we do incremental accounting. How to do that? On grant date, calculate 3 values. Total value of equity, total value of cash, and the incremental equity. Incremental equity, directly divide by the vesting period and book it across the tenure. What about cash? You cannot directly divide by 2. Why? Because cash settled gets affected by changes in fair value. So for cash, compute the expense separately. On year 1 end, based on the year 1 end's fair value, and on year 2 end, based on the year 2 end's fair value. Okay. So don't tell me that why did we compute cash settled value then to find the incremental equity on day 1. Okay. And also, if the incremental equity comes to 0 or negative, you will do no accounting for equity, just to clarify. Then we did the accounting for equity as well as cash. We did the accounting. If the employee chooses cash option, what to do? You will reverse the liability, give the cash, because we have made the full provision for cash. So make the payment of cash. Whatever is the balance of reserve will get transferred to retained earnings. Simple. Is this clear to everyone? Yes, sir. Acha. There was one more question, illustration number 6. Based on the same grounds, you can solve it on your own. The only thing I discussed extra was, I discussed both the options. What if the employee chooses cash? We already know. Liability to cash bank, then reserve to retained earnings. What if the employee chooses equity option? So I will only discuss what ICAI has done. So what ICAI does is, they reverse the liability. From this liability only they give the equity shares. So liability reversed to capital to premium. And whatever is the balance of SBP reserve, transferred to retained earnings. So ideally it is easier for you. Why? If they choose cash, do to cash bank. If the employee chooses equity option, then what to do? Reverse the liability. Give equity from this only, up to face value, capital, balancing figure, premium. This is what ICAI has done. Anyways, so this was SBP with cash alternative that we discussed. Now the next point is group share-based payment plan. What is the meaning of group share-based payment plan? Let's say subsidiary announces a plan, but shares will be given by parent. So when subsidiary announces a plan, can I say employee benefit expense will be booked by subsidiary? But when parent is supposed to give shares, parent will say to SBP reserve. Now in both the companies, the entry is incomplete. So when can I say parent is helping subsidiary here by giving the shares? So parent will say help means investment in subsidiary, and subsidiary is receiving the help, so it will say capital contribution. Why it is help, sir? Because to the employees of subsidiary, parent is giving shares now. Simple, right? So whenever parent is helping subsidiary, parent will say investment in subsidiary to SBP reserve, subsidiary will say employee benefit expense to capital contribution. Based on this, we did 2 or 3 questions also. Okay, but the important part here is one question I will discuss, where in illustration number 23, what was happening is, I will show the illustration also if you want. What was happening is, here subsidiary is saying that I don't want the full help. Whatever help he will receive from the parent, he is ready to reimburse 75%. So let's say he is receiving a help of 5,000. So he will reimburse up to 75% of the help. So how will you account for such type of question? Do remember, when subsidiary is ready to reimburse, subsidiary books the full expense, but in capital contribution he will not book full 5,000 rupees. Why? Because he is going to reimburse the parent for 75%. So whatever he will reimburse, he will say to cash bank, and whatever help he will receive, he will say to capital contribution. Similarly, parent will say to SBP reserve full 5,000, but because he is reimbursing 75% cash bank, he will receive 75% cash bank, and help is only 25%. So investment you will debit only 25%. Okay, I'm just revising the question from above. Of course, do solve them in detail as well. Okay, again to remind, this board notes I will upload on the Telegram. These board notes in itself are self-sufficient for your coverage. Okay, there is one more concept here, that is the concept of grant date and measurement date. We have one question also based on that. What is the concept? Do remember, share based payment can be between company and employee, can be between company and third party. In case of company and employee, grant date and measurement date are the same. What is the meaning of grant date? The date when we agree for the share based payment, final approval date. And measurement date is the date when you calculate the fair value for measuring the SBP. So in case of employee, when the day it is a grant date, that day only you calculate the fair value. So grant date and measurement date are the same. In case of third party, grant date is a date when we enter into the agreement. But when is the measurement date? When you receive the goods and service. These two dates can be different in case of third party, right? So if they are different, then grant date will be the agreement date, measurement date will be the date when you receive the goods and service, right? But these two can be the same also. But in employee, they are definitely same. In third party, they can be same, they can be different. Do remember. Based on this, we have one question, that is question number 2. I will just show it to you if you want. Sorry, question number 1 of MTB RTP if you want to see. See, in first case, it is said that employees, final approval was there on 30th June. So in case of employees, grant date, measurement date are the same. Second, we entered into a contract with a third party to purchase IT equipment. Contract entered 1st April, grant date 1st April, but equipment was received on 30th July. So measurement date 30th July. Simple. Third case, employees, final approval was done on 30th September. So in employees case, both data are going to be the same. Simple, right? Okay. So this was the revision of Ind AS 102. But let me see if I have missed out on any question which I wanted to revise. If yes, then I will revise that question as well. 7 we did. Then cancellation we discussed. Modification we discussed. Market based measurement we discussed. This also we discussed. 21, 22 also we discussed. 23 done. Okay, one discussed. Acha, there is one question number 2 also, which is based on Ind AS 102 and Ind AS 10. I'll tell you in a very simplified manner what is the crux of this question. Just have a look here. I have prepared a chart for you that will help you revise it very easily. Okay, see. So what happened is, we announced a plan here. In that question, we announced a plan on first day. 2 years is the vesting period. Okay, and after the vesting period ended, on the exercise date, the fair value has increased to 9. So on the first year, fair value was 6, then it became 8, then it became 9. Okay, and they have mentioned that the FS are approved on 12th of May. So this fair value increase, is it an adjusting or non-adjusting event? Because if you treat it like an adjusting event, then you will change the fair value of this 9 in the previous year only. But of course, there were no condition existing of this increase. So this is the non-adjusting event, right? So if on exercise date, the fair value is 9, you will not change the fair value on previous year end. So you will book the expense on 31st March 13 first. Date is wrong, sorry. You will book the expense on 31st March 13 as per based on 6 fair value. Then you will book the fair expense on 31st March 14 based on 8 rupees fair value. And then during exercise period, when you are making the payment, because the fair value has changed, during exercise period, first you will remeasure and then you will make the payment. Do remember that. Okay, so basically the only concept was that because of the change in fair value after year end but before approval of FS, this is a non-adjusting event. Okay, yes, so this completes our complete revision of Ind AS 102. I hope it was helpful for you. Tried my best to revise all the concepts along with the relevant important questions. Of course, your self practice is needed. Just watching the revision won't suffice, so do self practice the questions as well. If you like it, leave a comment in the comment section. Also, if you want more revisions, also leave a comment. Okay, thank you so much. Bye bye everyone, take care, see you all.